these are types of investments that don't provide these tax advantages, but that's okay. They provide a better, healthier, more risk-adjusted portfolio because when you go to sleep at night, this sliver that you put in the legal industry, it's not going to rise and fall with the rest of your portfolio. And that's important, right?
Hey, everybody, welcome back to another episode of the Richer Geek podcast. Today we have Patrick Grimes. He's the founder CEO of Passive Investing Mastery, an internationally best-selling author and a Forbes Council contributor. He's a serial entrepreneur specializing in alternative investments. Sound familiar? We love alternative investments. His portfolio is diversified across energy, litigation, finance, which is interesting, commercial lending, acquisitions, including retail, industrial, and thousands of apartment units. He's developed a range of diversified passive investments focused on growth and cash flow, including diversified litigation portfolio, acquisition funds, income funds, all designed to thrive during economic downturns. We may or may not be going into one, so it'll be nice to get to know his thoughts on that. Based in Honolulu, he's dedicated to educating investors on achieving financial independence through mastery in passive alternative investing. How you doing, Patrick?
I'm well. Yeah, you read the whole bio there. we gotta abbreviate that a little bit.
Well, it was all fascinating, so I wanted to make sure that people knew what you do and how you do it. But backtrack a little bit. How did you get involved in passive investing?
Well, probably like many of your listeners, I was a high-paid professional slaving away the job. I was a machine design, automation, and robotics engineer. And it was around that time when I graduated college, a couple years in, I was talking to the owner, hey, where do you invest? How did you make your money? And I was thinking he was going to tell me this startup, this gizmo, this gadget, we got the insider track. He was saying, yeah, I made all my money in high tech, but I invested in real estate. And he asked me to do the same, and his only regret was not doing more sooner. So that's really what got me on the track into alternatives. And it was really about diversifying out of high tech, right? Knowing that I'm maxing out the 401k. I've been stashing away cash into, some savings accounts. What am I going to do with it? And I was probably too eager too soon. Lost a lot right off the bat, but found my way to non-correlated and diversification into non-correlated investments.
Yeah, it's a lot of us. I got started, I call it PG, pre-Google days, and it was easy to buy a lot, but then it's now what? And you can't go through the yellow pages on how to be a landlord or how to evict people. So, it's a learning process for a lot of us. So let's talk about some of the lesser known aspects of investment diversification that you get into. Sort of like the litigation funding or some of the other types of funds. So what are you into now?
Well, so you kind of pointed at a little bit ago, are we headed for a downturn? Well, 11 out of the last 14 Fed rate hikes ended in a bust in the market. And right now you have that happening with the world's biggest economies betting against the dollar. Interest rates and inflation has been somewhat unstable. And now we're in a tariff war. Holy shoot, there's a high probability that we're in unsettled or at least unpredictable times here. So I've been looking at a combination of recession resilience, kind of overlapping non-correlation, which means investments which don't have the same market fundamentals as the rest of your portfolio. It's not going to rise and fall. It's not dependent upon the same variables. For example, in the legal industry, the outcomes of cases doesn't have anything to do with what's going on in the stock market. Doesn't have anything to do with what's happening with oil and gas or gold or interest rates. It's called non-correlation. So invest funding attorneys that are pursuing cases and participating in those settlements can be a completely non-correlated investment. And the legal industry has just risen It's been a steady, tried and true growth industry. So we call that kind of the intersection of recession resilience and non-correlation. The more common ones people know about are the medical industry. People need healthcare and upturns and downturns. People need education and reskilling, upskilling and reskilling, upturns and downturns. CPA firms, plumbers, HVAC, all these kinds of things don't ride the same fundamental variables.
Yeah. So, it's interesting that, a lot of us think, well, apartments, homes, that type of real estate, storage facilities. People don't think about, the legal aspects. It's like you can actually invest in attorneys. I know that some people invest in outcomes, or the bails and all the bonds and all that sort of things, and they fund those. It's very interesting. How did you learn about the litigation side of investing?
Well, so it was several years back, actually, that I was trading the baseball cards with just a couple buddies of mine on alternative investments. And that's pretty much how it is.
Yeah.
Because we started a platform in my company where we introduce new alt assets every 2 weeks. But really, there wasn't still to this day, other than my platform, I don't know where else you go to get all the different kinds of alternatives out there to invest in. And so it was more just us getting together, and one of my buddies, Dennis, who wrote the Alternative Investing Almanac, he had litigation finance in there. I was like, wow, that's so fascinating. I had talked with him originally about getting involved in a deal, and we were working on putting together some seed funding with a couple guys to give it a go. But it was tough. It was tough to access because the attorneys were really looking for bigger checks. They were looking for $5, $10, $20 million checks. And litigation funding, where third parties come and help fund the costs of lawsuits, it's been going on in our country since 1910. It's a fairly well-developed industry. It's just not very well known, and it tends to be gobbled up by larger institutions, hedge funds. So I learned about it then. That didn't pan out. I was duking it out with a good investing friend of mine on some multifamily deals. Yeah. And turns out I learned that he worked for private equity, did private credit, all kinds of creative finance solutions, consumer debt, as well as Amazon warehousing. And all of a sudden he said merchant advance and litigation funding. And I was like, wow, there we go. Let's talk about this. So I've, through dueling on a few different multifamily deals together, we had developed some respect for each other. I approached him when he started at a large equity firm. Hey, let me write you a check. Let me aggregate some capital. And they turned us down because we couldn't commit to a $20 million check. And I was like, dude, that's like the smallest chip you guys have at your table.
Wow.
But years later, after us, catching up here and there, he called me up and said, look, I left that company. I'm now in California and moved back. I moved out of New York. Let's start a fund together. Let's do one for accredited investors, which had been my ask for a while. Let's offer it. And so it's been a really great ride. It's been a lot of fun. And he's used to spending 20, 50, $100 million and collecting hundreds of millions and billions out from large. So he's in the flow, and he's got a lot of deal flow. It's been really fun.
Wow. I mean, that's amazing. Ladies and gentlemen, you can do it. You just have to get with the right people and learn, and again, it's Patrick Grimes, passiveinvestingmastery.com. Now let's talk a little bit about, a lot of people sit there and say, I make a lot of money. Can I use some of this stuff for tax efficiency along with growth? So talk to us a little bit about how that stuff works with tax efficiency. Everyone kind of knows with the depreciations and deductions and things like that. With some of the alternative stuff that you do, how can you maximize tax efficiency with what you do?
Well, so if you look at any of our slide decks, we have these pie charts or bar graphs that talk about the allocations of the kind of the middle class, the high income, and the ultra wealthy. What you find is that they're not over allocated in tax efficient investments, like 24, maybe 25% in real estate, maybe 5 10% in commodities or oil and gas, but not the majority of their portfolio is not in tax advantaged investments. And why is that? That's because those tend to come with higher risks.
Mm-hmm.
And they're incentivized because the government needs to house, feed, and energize America. But you don't necessarily want to ride the majority of your portfolio there. So when you're looking at alternatives for things like litigation funding or the medical or CPA firms, these are types of investments that don't provide these tax advantages, but that's okay. They provide a better, healthier, more risk-adjusted portfolio because when you go to sleep at night, this sliver that you put in the legal industry, it's not going to rise and fall with the rest of your portfolio. And that's important, right? That's not an answer to your question. The answer to your question is, even in litigation funding, there is some ways to turn the returns into capital gains instead of ordinary income. But there isn't specifically a way for you to turn the investments into losses, right? But we are right now in a fund where we've structured it as prepaid forwards, which allow for capital gains, which those are sophisticated enough to play that game. They can use other capital losses to offset and make a win for them.
So, a lot of people that I talk to, it's like, okay, I'm going to start buying. I'm going to start doing when there's a downturn because that's when all the deals are, right? So, what do you think about that? Don't wait for the downturn, wait for the downturn, both. What's your strategy?
And I've talked to over 1,000 investors right now, and those ones that are drinking the Kool-Aid in the stock market, they're on the ride, right? They're riding it up. Oh, man, I'm just killing it. I'm doing so great. I can't pull out. I can't pull out. And then the next day they're like, oh, shoot, I can't pull out because I have all these unrealized gains that I lost, quote unquote, air quotes, lost money. As soon as it bounces back up, I'll invest. Oh, I should really be doing these alternatives. It's at one point you got to realize you've been sitting in Vegas, you've been sitting in a giant casino paid for by the chips that you're losing at the table, and you've just got to take some of those chips off that table and go somewhere else, because there are actually much more sane places to invest and places that won't all be on the same roller coaster. If they're on a roller coaster at all, sure, it won't be as exciting. But the human condition, and my sister is a developmental psychologist, the human condition is actually that humans get addicted to the loss. They actually get addicted to that loss feeling in a casino. And so it's very difficult to get them out before that. And it's difficult to get them out once they feel that they've had a loss. So I'm feeling that now. But right now, it always makes sense to be in a portfolio, which is with an allocation strategy. And I'm not making this up. This is how the family offices, hedge funds, private equity, this is how the wealthy build. Allocation strategy. It's not a conversation of what's tax advantage here, what's not, if I should get out of the stock market or not. It's here's the 10 or 5% there is 20% there. If you look at our slide decks, we kind of break this up, where each of these pillars of your wealth do not ride the same variables. It's not whether or not you like the stock market. It's about that's an allocation, and you can ride that. But if that's the case, then you developed actual security that won't get swept away by any one tidal wave. And you're talking to a guy who doubled, tripled down, snot-nosed engineer right out of college and lost it all in real estate during 2009 and 10. Sure, I was a gainfully employed engineer and I bounced back. I was battered and bruised and ego was hit, and it took me a while, but you just simply can't be over-indexed in one asset class. And it right now, or at any point you find yourself there, you just got to take those chips off the table.
Yeah. And, and that's, we're looking at it also in our portfolio. And, I've been talking to my directors, and it's like, should I be all in hotels? It's like, man, in case COVID 2.0 hits, it's not good. So it is nice to diversify. So, let's talk a little bit about tech. AI is the big thing. How are you using AI? Is it a lot of us, it's a time saving thing, or sometimes it's not, because it seems like I argue with AI so much that it doesn't really save me time. So tell us about how you're using AI.
Oh man, I mean, we probably want to narrow it just a little bit. My techie background just really, and I tend to be a processor. I have a master's in engineering and an
Mm,
MBA. So there's a broad spectrum of ways that we use AI in the companies that I'm a part of or I'm running. More specifically in our underwriting, there's AIs now, machine learning algorithms to aggregate data to help us come up with very creative buy box to help identify patterns and
mm,
different kinds of distressed data to help find those types of investments which are better. We use AI now for uh, let's see, what's some of the really good examples? Because I mean, obviously AI is used in graphics and marketing a lot.
yeah.
Um, there's apartment buildings we have where once they're stabilized, not necessarily ones that need a ton of work, but once they're stabilized, getting AI as the responding to all the maintenance service requests and scheduling the work,
Mm,
automatically following up from the maintenance requests and requesting a survey. And if that survey is successful, immediately suggest a Google review and a Yelp review, and then
mm,
incentivize them. But you're selecting then good reviews, and as your reviews grow, your rents grow up. There's a direct correlation there. So automated booking. So when people come in, they can read an automated agent. That means that the leasing agents can actually be there with the people and actually be answering the questions rather than constantly booking. And those AI agents can follow up
yeah.
with the rental applications and keep that process going. They can actually record follow-up dates and then follow up. Um, those are some of the examples that, we could keep going, but
Yeah.
I know it's supposed to be a dialogue.
Yeah. No, that's okay. I mean, it's just, I always ask the people because it's fascinating how different people, different companies use AI, and I'm glad that I have people that do that, because I am not a techie, and it's kind of like what you say in your business talking points. Find your unique ability and then outsource everything else. And
Hmm.
that's really important. At what point in your career in investing did you say, you know what, I'm working too much on stuff that I don't like or I'm not good at?
Well, so I remember when I first read the 4 Hour Work Week. I don't know if
Uh-huh.
this was like 25, is it 25 years? Something insane like that, right?
I
It
know,
was a long,
crazy.
long time ago. And I hired in the first edition of that book, Brickwork Indian, Ask Monday, those two companies that and I created the sheets, and I was an engineer
Mm,
at the time. And they had me doing some R&D work and identifying, and I was working on some glucose diagnostics test strip stuff. I actually wrote these scripts to go compile, do searching, compile from LinkedIn, all the different people that worked at the companies with certain titles,
mm,
and then go through and research um, which ones had likely in the R&D or in the manufacturing or all these keywords, and then come back with what their emails are. And then I would write templatized scripts, and then they would go and email them through my account. And I mean, I started this back in my engineering days, and I carried that forward. I had used, in fact, I've been using, there's a different company that I've been using um, uh, for almost 20 years now that it's just been really great to me. And I've carried that same kind of methodical kind of systems and process kind of automation into real estate, where I was at one point, I had them looking at all of these potential opportunities and helping to vet and make connections and meetings with prospects, whereas I was just busy, doing my architect, kind of doing my robotics and automation stuff. They were help keeping, my pipeline full of new things to look at. I'd all of a sudden transitioned right over into real estate, and um, there really wasn't any hiccup, and it
mm,
really wasn't a change in scope. It was just similar kinds of SOPs, which were very detailed and iterative. because they'll go down rabbit holes and similar kinds of controls. And I just was spending large amounts, mostly through Upwork in the latter years, because it really became dominant in that space.
Yeah.
Most through Upwork. We're a virtual company, and my director of marketing lives in the Bay Area in San Francisco. I have people in Texas, but we also have a lot of people in the Philippines and India and South America now, and we operate through Slack, and
Yeah.
we have quarterly, weekly updates. We've implemented EOS, and it's just been a really cool, exciting time for us overall. And it creates for a really fun atmosphere too. I mean, we had a company summit here in Honolulu, so that was pretty cool last year. That was the first time we did something like that. But we certainly have our good times over Zoom.
Yeah, it's Zoom, Slack, WhatsApp. I mean, all of a sudden it's like, man, and what I don't know if I could survive without those three, and I use WhatsApp a lot, with my international investments and international people, and it's just crazy. Something we have in common, is, we've both owned a lot of apartment units, and I love to hear I could go on for an hour with some of the challenges I face scaling. What kind of challenges did you face, and what lessons can you tell us that you learned from all of a sudden? I started out with the fourplex, and now I have thousands of units.
Yeah. So, well, first, you say fourplex. I call it residential, non-commercial, right? Because I did a
Yep.
bunch of single family like you did before. The single family thing was working. I was working full time, and I was moonlighting the single family thing, and I was doing it all on my own because I had lost money before.
Hmm.
Wasn't very trusting of others at that point. I was very careful, cautious. Engineer already very conservative, and now I've lost it. And so I didn't really partner with much. And I was hyper focused on recession resilient assets and markets. So I went specifically with 2 bedroom, 2 bath because they had been the biggest winner for the longest time. I went specifically in Texas and narrowed in on Houston because it had the strongest performance through 08, 09. And I was underwriting, analyzing deals, talking to contractors, talking to property managers, renovating, talking to lenders. And man, I'll tell you what, that was brutal. And
Hmm.
I found myself churning through these and was thinking to myself, okay, I'm 1, 2 years. And by the way, simultaneously, I had just finished a master's in engineering and an MBA. I was now doing projects with Tesla and Lockheed and J&J and Abbott. And I was doing some really amazing stuff, flying around a bunch, trying to date. And then I realized that you just simply can't do it on your own. You
Yeah.
need people in the markets. You need people who are programmed in all these different ways. They have savants in these different. And so my wife was there for my very last single family closing because I realized I couldn't scale this single family business the way I had and not make trade-offs that affected my family, friends, hobbies, things that I cared about most. And so I told my soon-to-be wife, hey, I'm going to take a break from this. She was there for my very last single family closing. We were at a coffee shop in Chinatown in LA, and we were heading out for dinner that night. Then we got married. I married her. So it was a good choice. That wouldn't have happened. But then I learned to partner on the other side. It was a good 2.5 year break before I went into apartment buildings, and I learned to partner and with other operators and other markets. And that's how I was able to scale and let other people have their savants and find where I can bring value and balance to my life.
Yeah, and ladies and gentlemen, if you hear that, it's going to be hard for you to spend money in order to gain freedom, but I don't think you'll ever grow properly unless you start putting out chunks. Have I hate CPAs, so why am I paying the bills? I hate. I'm not going to say I hate people, but it's like, why am I dealing with the tenants? Because I get a
Mm-hmm.
little frustrated with them. So you have to find people that will help you out so that you can grow. Um, what do you think are the biggest trends going on, let's say the next 5 years, 10 years? What are you seeing as far as the alternative investments? Anything new, anything big? What's the next big stuff?
Well, so right now I'm really big on litigation finance. I'm really big on these
Yeah.
investments that do not, and we have an income fund and an acquisitions fund, by the way. Those are both one of the coolest opportunities of my lifetime because, as you know, I lost big in 2009 and 10 when it was the best buying opportunity for residential real estate, single families. Now I'm in commercial real estate, and we had the 2009 and 10 happen for commercial real estate. Commercial real estate's taken a huge colossal hit, and right now it's the best buying opportunity, and if you move at the right time. So we are lending in our income fund and we're buying in the acquisitions fund, and we're getting outsized returns on both, and it's just a really incredible opportunistic play for us. So that's going well. Meanwhile, we educate constantly on, again, those pillars of completely non-correlated diversification, not lots of different kinds of hotels or real estate or even geographic real estate, different things that don't care about tenants, toilets, and trash, different things that don't care about interest rates. And so we are ventured out into the legal industry, and we have a bunch of side projects going on that I usually, for every four or five different things I'm dabbling in, I'm working on, usually one pops out where it's like, okay, let's have everybody jump on board with us here. And we have a number of those cool projects right now on the sidelines that I'm looking forward to kind of launching here as the year goes on.
Yeah, and you're looking at, what I'm thinking about in the next 5 or 10 years, whether or not EVs make it or not. I think they will, but it may not be lithium. It might be natural gas. I mean, who knows? But I don't think they're going to go anywhere. So, you look at different alternative investments, and there's the precious metals that goes into all these different things. And I know people are starting to kind of look at investing in precious metals, and instead of just gold and silver, they're things I've never even heard of. These precious metals, but there's all these different things.
The rare earth metals, right?
The rare earth metals.
So I flew from Honolulu to Frankfurt. So that is literally like a 12-hour time change from one side of the planet to the other. 10 or so days ago to meet with a rare earth strategic technology metal distributor out there, because I actually am really big. I mean, I talk a lot about gold and silver, and I'm killing it there, doing really well.
Gold is really good right now.
When I bought, it was at a high. But I knew at that point I needed to take some chips off the dollar table. I needed to get some cash out of the bank that was deflating, right? And the value I was losing the value, it was inflating. So I wanted to get it over into gold and silver, and man, that has just done really well. But if you look beyond that, to your point, you look to, well, what are the other metals? Well, there's palladium and platinum, and that kind of fulfills like that precious metals. But those, really, the gold out there is just sold to other investors. It's not really traditionally the gold you receive at home, the silver you receive at home, the palladium or platinum you receive at home are typically not even in the right form to go into industry. Yeah. But gold and silver are traded as store of wealth. Palladium and platinum are really the underlying value is for industry. So it's kind of misdirected, if you will. But if you're really going to say, okay, how do you get a diversified metals portfolio? Well, you've got to look towards gallium. You got to look towards vanadium, hafnium, indium. And then all of a sudden you get this like explosive, oh my gosh, you've got these metals. Some of them have gone up over the last 5 years, 100x, 200% or 100%, 200%. Like these, and they're commodities like oil and gas, they'll rise and fall. But in a hold play, you can do really well. And there's a totally different ballgame, because these are not sold with pretty little ingots that you're going to sell to another investor. These are held in custody control in certain controlled environment and certain vaults that are rated and audited by tier 1 suppliers like Siemens or other companies like that, so that you have an exit not to another guy who's, you imagine the gold pawn shop. You have an exit to an industry supplier, and this is in the form factor with a chain of custody that can sell it. And that world And so this is like one of like 20 or 30 different alts we can talk about. But that world of the strategic rare earth technology metals is a far better play. And lithium's not on my list. Why? Because, as you just said, it has a high obsolescence risk. Because right now there's a bunch of different alternatives that are a lot less dangerous, more plentiful, and less toxic to the environment. And so there's a huge movement going towards moving away from it. Not that it will happen overnight, but I'm more interested in the ones which they're like, for example, in California, where I was originally at, there's one of the largest underneath the salt flats there. I think it's in the Mojave or in the Owens Valley, one of the largest locations for lithium in the country. I mean, it's just sitting there. Those things can just be harvested with a flip of policy change, right? I'm looking for ones that can't just be flipped like that. I'm looking for ones that have an inelastic supply chain. The ones that are going to continue to remain scarce because maybe they're a byproduct of some other manufacturing process like zirconium or aluminum. The manufacturing process produce other things, and it's hard. It's not possible to just double and triple these things overnight by mining directly. And so these other ones are a bit more inelastic. They provide a little bit higher risk. Now, when you look at ones that are, in addition to that, used across varying industries and varying products, as you say, the AI products, the semiconductors, solar cells, EV vehicles, additives for fuel, touch screens. That's like those. You can find these rare earths used in all these different kinds of products. And maybe I'm like half in rare earths and half in strategic metals, or not necessarily all rare earths. But if you find the right cross-sectional portfolio, you can get a really high-performing, well-developed metals portfolio. And that most certainly is something I'm really big on.
Yeah, I agree. We're running close on time. So what happens when people, they're interested, they're like, oh, wow, all these different things is just something else that I can invest in. So they go to passiveinvestingmastery.com, they click on it. How can they learn more?
Yeah, so at the top of our webpage, we have our 3 investments: the income fund, real estate asset-backed debt fund. You can opt in there. We have our acquisitions fund, where we buy things in cash. It's a high growth income fund, steady cash flow. Acquisitions fund, high growth play. And then we have our diversified litigation portfolio, which provides non-correlated growth to a portfolio and rides a completely different wave. And so you're welcome to check those out. All the information's there. On that website, I also have a Calendly link. You can go to passiveinvestingmastery.com/contact or just click contact. And I'd love to talk to anybody. I'm happy to do so. I offer a copy of this book here if you'd like. We just need to make sure that you put the name of the podcast in the form at this link. It's passiveinvestingmastery.com/book. passiveinvestingmastery.com/book. If you fill out the form, you can either download the ebook or download the ebook and get a hard copy. We sign them and send them out. And there's me in here. I tell my whole story, the ebbs and flows, the trials and tribulations in and out of high tech and single family and apartments and energy. There's a Navy SEAL on here. Brian Tracy did the forward, Dennis Waitley, a bunch of really cool rock stars. Literally, that's Phil Collins, lead guitarist of Def Leppard. It was a really cool book to write and continue to work with these guys. If it helps you, inspire you along your journey, that's enough for me. So I offer this to people. We ship it out. And, if you're sitting at home thinking like, what, I like what he's saying, but man, it seems super out of reach. Like, I don't know how to access different kind of novel investments, which are not real popular, like oil and gas or real estate or stock. How do I get involved?
Yeah.
The most common question I get is, hey, Patrick, what are those? What are your favorite investments, your favorite alternatives that anybody can invest in today to start building true stability in their portfolio? If you go to a link, I provide that to you. I provide a download, and it's investwithpatrick.com, investwithpatrick.com. And right on that page, we have the download, and it's one page that provides literally like, here's my favorite alternatives anybody can invest in today to begin starting your journey of building more security in your portfolio into non-correlated investments. And then if you want to read more, I have a bunch of pages behind that first page, which goes into whatever ones you're interested in. So in the meantime, set up a call wherever you're at in your journey. I'd love to have a chat with you. And if I'm not a stop along the way, then I'm happy to get you pointed. In our alternative series, we interviewed over 40 different alt asset sponsors right now, completely different alternatives. We'll find something that's a good fit for you.
Yeah, absolutely wonderful. Well, Patrick, thank you so much for coming on the Richer Geek podcast. It's been enlightening. I think I'm going to check out passiveinvestingmastery.com myself. Maybe I need to diversify a little bit. So, before we leave, accredited investors.
Yep.
Yep.
Accredited investors. Yep.
So, ladies and gentlemen, if you're an accredited investor and you're wanting to diversify into something that's out there, as far as it's not the normal real estate, it's not your storage or mobile homes and those types of things. If you want to diversify into something that is more recession proof, check out Patrick at passiveinvestingmastery.com. Thank you so much for coming on the Richer Geek podcast, and surf's up. Enjoy that Hawaii weather.
Thanks for having me. I will.
All right, take care.